we're going to be talking about tail risk, talking about the risk of an extreme event occurring that could drastically change the value of a portfolio or investment. We then talk about something called kurtosis, which is statistically the tailedness of the probability distribution. So tail risk is this extreme event, or the risk of an extreme event. Kurtosis measures how much of that tail risk you have. Okay, kurtosis is a measure of tail risk. It specifically provides information about the tails and the sharpness of the distribution. It's a measure of risk or opportunity ultimately. So tail events are very rare in normal distributions, and normal here, we're not using the word normal colloquially. We're using it fundamentally as a definition, so a type of distribution, a Gaussian distribution. But in finance, they're much more frequent. So we see fatter tails, much fatter tails than people realize. But there's also the tail of the tails. So tail risk, and then the really edgy stuff in the tails. We're going to talk about that too. Okay, the tail of tails. Let's turn those words into pictures. Okay, so I'm going to give you two distributions. One is going to be in blue, dark blue. It's going to be the normal distribution. And the one that's in orange or gold, or however you see that color, is going to be a fat tail. So it would be what we would call larger kurtosis, right? The tailedness. Okay, so the next thing you're going to see is two charts, one on top of the other. Okay, so the blue one is normal. The orange one is fat tails. What do I mean by fat tails? First of all, what are we looking at? The vertical axis, up and down, is the frequency of an event. So the events in this area occur very often, the most often for these two distributions. The events that occur over here or over here, right, they're lower on the vertical axis, they occur less frequently. But in the orange or gold distribution, the tails are bigger. These are the tails, right? So the likelihood or the frequency of a loss is much larger. This is the kurtosis. The frequency of a tail event is much larger. And in particular in this one, same thing on the right-hand side. The frequency of an event is larger, right? This level is larger than the level down where the blue is. Okay, this is fat tail distribution. Okay, so when I say kurtosis, I'm talking about the fatness of the tails. And when I'm talking about tails, I'm talking about events which happen less frequently. All right, I'm going to take this image you see, and I'm just going to stuff it in the right-hand corner. These are fatter tails that we looked at, right? I'll go back. These are fatter tails, but they're symmetric. You guys see that? They're symmetric. They're fatter here and fatter here the same amount. So same size tails. This is the downside tail and the upside tail. So we can talk about kurtosis, right? We can talk about tail fatness, tailedness, but we can also talk about the symmetry of it. What if we could find stocks where there were asymmetric tails, right? So for example, a bullish speculation, we would want the green, but not the red. We'd want this, right? But we wouldn't want this. We'd want an asymmetry. We'd want the upside to be greater than the downside. Or in a bearish speculation, we would want the red, but not the green. We'd want this, but not this, where the downside is greater than the upside. That would be an asymmetry. So this combines the fatness of tails analysis, kurtosis, with asymmetry. So here's our third definition. Skew. Skew is a measure of asymmetry. So we have tail risk. It's the risk of an extreme event. We have kurtosis, which is the frequency of that extreme event. And then we have skew, which is the asymmetry, right? In the context of stock performance, the skewness or the skew refers to the measure of the asymmetry of the probability distribution. And as luck would have it, there's two kinds of skew. There's positive skew and there's negative skew. So now let's talk about skew in images. So this is one example of negative skew. You notice that like the tail and everything's to the left-hand side. There's no upside tail. Now, or here's positive skew. This is what people in standard would call the log normal distribution. This is stock returns because stocks can only go down to 100%, right? There is no tail risk in a stock. It can go down to zero. But hypothetically, and we're being hypothetical now, a stock can go up infinitely. So that's positive skew, that's negative skew. If that picture didn't work for you, okay, that's okay. Let's try a different chart. That's one. I'm trying another one. This is what a normal distribution would look like. Normal meaning a Gaussian distribution, not normal in the colloquial sense. And it's a positive skew, kind of leaning over here, and there's a negative skew, kind of leaning over here. Okay, all right. So let's talk about it a little bit. Remember, I said in a bullish speculation, we want the green, but not the red. In a bearish speculation, we want the red, but not the green. And then we started saying, well, gosh, what if that means we kind of want an asymmetry maybe? And then so we said, well, actually asymmetry has a name. There's positives. We would want positive skew and negative skew. So we're starting to get an understanding just at a high level, like what might interest us. I haven't proven that it does interest us. I'm just saying hypothetically it could interest us. We refer to this green and red part as kurtosis, and we refer to the asymmetry as skew. Kurtosis and skew. That's what we're going to be talking about today. This chart and this chart. Our research in the options space is rather famed. And please check my background after this webinar. When someone says our research is famous or we're published in certain places, check. I'm going to share with you the ideas behind what we've discovered. The spirit, I'm going to describe to you the spirit, but I'm not going to share the exact algorithm. So we did some research, some groundbreaking research in 2016. And it was about pre-earnings optimism. It's this idea that right before earnings, a certain group of companies tend to have this optimism that they're going to beat earnings and the stocks just rise. It's not an earnings bet. The trade closes well before earnings, actually a day before earnings. You just ride this kind of optimistic wave. And that research was very, very well read. And some of the largest firms in the world published it on top of us. And most didn't give us credit. Now, unfortunately, I cannot share it to you if it was privately sent to clients. But what I can share with you is what they did in public. So when I published the research on LinkedIn, some of the people at the firms weren't paying attention that they weren't logged in. And who were those firms? Goldman Sachs, BlackRock, BMO, Merrill Lynch, and Bloomberg. You can go onto my LinkedIn and you can see it. This is I'm not sharing anything that I can't share. Okay, so once bitten, twice shy. So how do you verify the results I'm going to show you if I don't hand you the algorithm? It's a fair question. So what I can do for you is you can just do it in TradeMachine. And I'll show you how to do it in a few minutes. Now, we've made our way all the way through this far. Now we're into results. So what I have done, hopefully for you, is motivated why we're talking about what we're talking about. And now I need to motivate it further because I can talk to you about a lot of interesting things, particularly in mathematics and statistics, which simply don't matter in finance because they've already been discovered. And my claim to you today is that this has not been discovered. But let me prove it to you. So you would do it through Pattern Finder or TradeMachine. Alternatively, you could do it through this webinar. I want to be very clear. I have not demonstrated that any of this matters. All I have done is demonstrated why it might matter. You could be saying, that's true. I'd like fatter tails on the upside for a bullish bet, or I'd like skew leaning, positive skew, or both. Hypothetically, it makes sense. It's a logical argument. You haven't proven it to me yet. And when I talk about it, I mean return distribution characteristics. I'm talking about the fatness of the tails. We can call it kurtosis. And I'm talking about the asymmetry in the return distribution, or skew, if you like. So it, why does it matter? Why do return distribution characteristics matter? Beyond a sort of pedantic conversation of how distributions could work. So the first thing I'm going to do is motivate it with stock returns. If we took the constituents of the S&P 500 in 2018, and I said, I want to see the average one-year return for every stock in that group from June 2018 to June 2023. 1 year return, every single stock in the S&P 500. The win rate, which is simply measured as were the returns positive or negative, was 59.4%. That makes sense. Stocks go up in general, in particular large caps. The average 1 year return was 10%. This is not me doing anything. This is observational. Then I said, well, what if we took a measure of kurtosis, which I'm not going to tell you exactly how we did it. It's not just the return distribution. And I just said it was greater than 1. This is already standardized for the normal. And the average return went from 10% to 13%. The win rate went from 59% to 63%. There was a 99.9% statistical significance. So what that means, there is a 1 minus 99.9% chance that we would find these results as they are, and that it would be random. 0.1% chance. Okay, let's say I said, that's interesting. What if I do you remember when I said the tail of the tails? Remember that? The tail of the tails? What if I said the tail, the upside kurtosis, the net kurtosis, was greater than 3? And again, for those of you that are statisticians, that'd be greater than 6. It's relative to the normal. All of a sudden, the win rates went from 63.1 to 63.9. The average return went from 13% to 15%. Statistical significance rose. Now, I'm only talking about the tails so far, right? I'm not talking about the asymmetry of returns. I haven't talked about skew. Well, let's do that. Okay, I'm not going to go through everything, but here's the last one. What if I said, well, what if I took the tail of the tails? I took the 1-year kurtosis, was greater than 3. I took the medium-term skew, 6-month greater than 1, and the 1-year skew greater than 2. So I took the tails of the tails, and I took asymmetry. Win rate went from 59% to 66%. And the average trade went from 10% to 20%, very strong statistical significance. So look, as we kept adding return distribution characteristics, how the win rates went up and the returns went up. So remember this. Remember when I said, I have not demonstrated that it matters. All I have done is demonstrated why it might matter. Now for stocks, I have demonstrated that it matters. The trading strategy was a triviality. There was nothing special I did here. I checked the skew and kurtosis for each stock in the S&P 500. And if it qualified, I held the stock for a year and I did nothing else. It's the results that are not a triviality. So I want you to imagine your win rates rising by about 10% with 99.9% statistical significance. And now I want you to imagine your day trading, your swing trading returns doubling. Just because I checked an annual holding period doesn't mean that we're going to do annual trades. So that's the takeaway for stocks. The strategy can be optimized. It was rather trivial. The results were not a triviality. This is a remarkable finding for stock traders. The ability to double your average returns and see win rates go up about 10% is life-changing, if it's sustainable. So it's a remarkable finding for stock traders, and it should translate into truly remarkable finding for option traders because options are levered. I said first I would motivate it with stock returns. It being return distribution characteristics. I did that. Then I said I would motivate it with win rates on option trades. It being return distribution characteristics. Then I said I would motivate it with win rates and returns on successful strategies that already exist in TradeMachine. Now, let me prove it to you. We just did the benchmark. Now, I'm going to show you a strategy that's in TradeMachine, fade the dip. It's also selling a put spread, but only when certain technical conditions are met, okay? The win rates go from 60% to 75%, the average returns go from a loser to a winner, and the statistical significance is through 32 decimals. Now, I'm gonna take the fade the dip and say I only wanna do it in companies where the skew is positive and the same kurtosis, the 1-year kurtosis is greater than 1. Fade the dip with tail dynamics, 17% returns. So what happened? Fade the dip is a winner. This is the immense value of TradeMachine as it exists currently. Current TradeMachine members, you've been getting a lot of value with this strategy. But fade the dip with skew and kurtosis is a bigger winner. And this is the start of the immense value of TradeMachine's upgrade. Just the start. We've just begun. And then I said I would motivate it with win rates and returns on successful strategies already in TradeMachine. I did that too. I showed stock. I showed 3 option strategies. I could have filled 5 hours with the strategies that exist in TradeMachine and how they've improved. This is the second time in my 25-year career that I've seen what can be called the statistical anomaly, or even an aberration. An aberration is a departure from what is normal, usual, or expected. This is remarkable. Remember the stock trading strategy? That was a triviality. It can certainly be improved. The results were not a triviality. I'm going to gray that out for a second. I want to talk about the options. The option strategies were not a triviality. So TradeMachine tested strategies already. The results were also not a triviality. I want you to imagine now on your option trades, your win rates rising by about 10% with 99% statistical significance, and imagine your average returns doubling or tripling. That's the option takeaway. These are the takeaways. A doubling or a tripling over the long arc of trades.